All right. Well, welcome everyone. My name is Diana Gonzalez. I'm a project manager here at dataoptim.com. I'm going to be your host tonight, and I'll be sharing a few details later on. Hold on one second. I'm going to share my screen here. So we will allow a few more minutes for everyone to show up. In the meantime, the speakers, the microphones will be turned off to allow the other guests to, the guest speaker to proceed with the presentation, and participants may ask questions at the end of the webinar via chat. We're just going to hold on for about 5 minutes before we actually start the presentation. During the course of the seminar, you can send your questions or comments through the chat, which you can find at the bottom of the screen where the menu is normally found. If you have any doubts about where to find the menu, that will be right here on this part of the screen. The tab will be open on the right-hand side of your screen, like this image to your right. The host will answer your questions as they relate to the topic that panelist is presenting, and they will be positioned in order of arrival. All right. Okay, so we are. Alrighty. So we'll just wait for 5 more minutes. Can't use it anymore. It's getting dark to see. I feel like I'm knocking on heaven's door. Knock, knock, 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 knocking on heaven's door. I'ma put my guns in the ground. I can't shoot them anymore. The long black cloud is coming down. I feel like I'm knocking on heaven's door. Alrighty, so we're gonna get started in a second. Hold on. All right. Hello, good evening, everyone. My name is Diana. I'm a project manager here at dataopting.com. I'm going to be sharing a few more details about us later on tonight. In the meantime, I wanted to give you a welcome to everyone to this seminar. Just give me 1 second. Hold on. So yeah, as I mentioned before, my name is Diana Gonzalez. I'm a project manager at dataopting.com. I'll be your host tonight. And I want to say hello to everyone who's here with us. Ivan Arturo will be speaking about financial planning for business owners shortly. Ivan Arturo is a certified financial planner. He has more than 13 years of experience in the financial service industry and holds a bachelor degree of administrative studies with honors in finance from York University. He earned the Chartered Life Underwriter CLU and Certified Financial Planner CFP designations. Both of these designations demonstrate his dedication to the highest ethical standards in the financial service industry. He's passionate about helping Canadian business owners achieve lifetime financial security. He's also among the top 1% financial service professionals worldwide, as recognized by the Million Dollar Roundtable, the MDRT. It is an independent international association of financial service professionals that focuses on settling the standard of excellence for professional financial advice. In his spare time, Ivan enjoys traveling, biking, golfing. During the summer months, he loves hosting backyard parties for family, friends, and colleagues. And with this, I'm going to hand it over to Ivan. Ivan, give me just 1 second. I'm going to put you pretty shortly on the screen. Okay. Okay. Okay, go ahead, Ivan.
Thank you, Diana, and hello, everyone. And thank you, Diana, for the introduction. And thanks to Data Opting for setting this up so we can share important information to business owners about financial planning matters. As you mentioned, I work a lot with business owners by helping them meet their financial goals for their businesses and also their families. And I love speaking with business owners, and the reason why, because I am also on the same page. And we're all here, we're on the same page. I'm sure like many of you feel that your business is like an extension of your body, it's part of your identity. So we're in business for many different reasons. But I guess, one of them, would be because people want to achieve financial freedom. Or maybe they want to achieve financial, also freedom of time. Maybe they want to have, the freedom of meaning and also relationships. But what's important right now is just like many of us, we have one or two key decisions that set us apart. Number one is the willingness, for you to take risk that most people are not willing to take. And you wouldn't depend on anyone else for your own financial success. So as you mentioned, I'm also an entrepreneur. Like all of you, I run a successful financial planning practice for the last 14 years, Diana, in the area of Richmond Hill. And also I provide investment optimization strategies for professionals and business owners. So I want to welcome to all of you. And as mentioned before, if you have any questions, so please feel free to write it on the chat. We have the QA box at the bottom. You can write any questions. But as I mentioned before, these questions will be taken up at the end of the presentation. So in case you have more of a specific question, we would like to do more of a one-on-one consultation just to answer any of the questions you may have. Okay. So for today's agenda, we're going to be discussing your financial roadmap. We have also, we're going to talk about money management and learn how to pay yourself first to increase your wealth. Business structures such as sole proprietorship, partnership, corporations. Financial risks that business owners face that could impact the growth of your business. How to invest inside your corporation and how to make good use of your current registered savings vehicles available to Canadians. And then, as I mentioned before, we're going to have, maybe between 5 to 10 minutes just to answer any questions that you may have. Okay. So here is a little disclaimer for this presentation. So this presentation is intended for information purposes only, and is not considered financial advice, as everyone's situation here are very different. We'll be discussing this more in general terms. And I guess we have attendees who are incorporated, those who are not incorporated, who are self-employed, or maybe you have a partnership. And I guess any financial strategies are totally different for every situation. So professional advice should always be recommended before making any type of financial decisions. Okay, so just a little disclaimer that for today's presentation. Okay, so let's start. So why it is important to have a financial plan, and why is, what's a financial plan basically? So a financial plan is important if you want to help put in strategies in place, such as retirement planning, tax minimization strategies, estate planning, and also to have an exit strategy from your business, investment and risk planning for you and also for your family as well. A financial plan is basically a full report of your current financial situation and recommendations that need to be in place to make sure that all of your financial goals can be achieved for you, for your business, and also for your family. And what's the end result? So a financial plan can help you save you to meet your short-term and long-term goals. That's number one. It will also help you manage your debt repayments, help you protect yourself, the key person in your business, and your loved ones. It could also help you plan for your retirement, maximize your estate, and also it will help you transition your wealth and your business to the next generation on a tax-efficient manner. So what are the 5 main reasons to have, a financial plan? So you can prioritize your financial goals and protect yourself along the way to help make sure your dreams are looked after. You could save money to reach your financial goals by implementing financial strategies that are tax efficient. It could also help you focus on the bigger picture for yourself and also for your business. It would help you organize your finances better, and you can separate yourself, or your personal financial planning from the business. And this is something that a lot of business owners have issues with, especially at the early stage of the business cycle, that they tend to mix the revenue that they generate from their business with the personal income, and this is the wrong way for you to get paid. The financial plan also could help you, worry less about money and financial matters, that you could also have, that peace of mind. Actually, the Financial Planning Council recently surveyed business owners who have been working with a financial planner. And it found that 70% of business owners say that they worry less about money because of financial planning. And they also stated that their emotional health had improved as they have in place, all the steps for you to achieve financial success. So financial plan is more than saving money. It's about what you desire to do or achieve in life. It would help you figure out where you're going and how to get there. What kind of strategies need to put in place to protect growth and transition your business to the next generation? A financial planning will help you retire with confidence. And that's the reason why we normally, and we suggest every business owner to have a written financial plan, so that way you can have, feel secure, build, protect, and also be able to retire with confidence. I'm sure many of you felt all the struggles that we faced during this pandemic. Some businesses more than others, for sure. But these difficult times will bring us to reflect on our priorities. A financial plan is a live document, as I mentioned before, and all of us may have to review it, our own plan, from time to time, so we could stay the course and be able to take advantage of the new opportunities. There are many, many mistakes that people make in managing their financial affairs. For example, they go too much into debt. They don't have enough income protection plans in terms of eventualities for you and for the key persons or the key people in the business. They may have, sloppy investments, and also they have improper saving vehicles with improper diversification. Some people, they accept advice without questioning the wisdom of that people who given that advice. Another reason is they don't know much about how much you're worth, and failing to keep financial records in place, knowing too little about retirement planning and what strategies to put in place, or making too little effort to reduce tax burden. So all these type of mistakes can lead to inefficient use of resources. It could lead to prevent you from meeting your financial objectives for you and for your business. It could lead to unprepared, be totally unprepared for catastrophes, pay higher taxes than necessary, may also delay your retirement and live on less money. Planning and reviewing your plan frequently will help you keep you on the right path to financial success. So a financial plan, the way you see here, a financial plan is based on a financial pyramid. There are many components to help us reach our financial goals to keep our focus on our main objectives. Here are the elements you have to consider in developing a financial roadmap in the form of a pyramid, all built on a solid foundation and a solid base with a good financial roadmap. So we normally start, from the bottom to ensure that you have a strong base. And this is by having a written financial plan that address all your personal and business objectives. This is normally produced with the help of a financial planner together with you and also with the different professionals. Then it comes to the legal part of having your wills and POAs properly drafted by a lawyer for your personal financial affairs. And this also needs to be done for your business, especially if you are a business owner who has a corporation or you have a partnership. As you can see, then we can move up to what we call the non-controllable events, which are the events that we don't plan at all, which you have no control, such as dying prematurely, suffering a disability, or critical illness that would affect your business and your family or your personal income. Suffering health issues that put you out of the game, and you might need to rely on savings or credit to cover unexpected medical bills and expenses. Many business owners feel, totally invincible, but the reality is that more than 50% of business owners fails due to the incapacity of the owner to operate the business due to any physical or any chronic disease. After that we have covered the non-controllable events, then we have the controllable priorities. Those are like, investing in your business and for yourself, buying properties, reducing debt, putting aside emergency savings for rainy days, education savings for your children, and saving for your retirement. All these are like action taker events that if you execute them, I'm sure that you will have, the results that you want to achieve. But you have the full control of executing these items. Lastly, in the financial pyramid, we have the growth opportunities. And those are the state preservation and tax minimization strategies, and also succession planning for you and for your business. Something that we call is very popular for business owners is what we call the exit strategy, and the wealth transfer to your family members and the next generation if you want to keep the business in the family. As you can see, financial planning covers all the risk aspects that may put you out of business, which is the foundation, but it also helps you plan and grow so you can achieve financial success and enjoy all the benefits why you became a business owner or an entrepreneur in the first place. So this is like the very, beautiful way to describe why people should be able, to plan themselves using this financial pyramid from the bottom going all the way up. Okay, so we have a concept here called pay yourself first. Basically, pay yourself first means setting aside a portion of your income to save before paying your bills and other expenses for your business. Make saving a part of your new budget, just like any other expenses that you're already paying at the moment. And start putting aside a specific amount of funds that you can afford on a regular basis. As a rule of thumb, we financial planners recommend clients to set aside between 15 to 20% of your personal income and put these funds for your long and short-term financial objectives, and try to live on the remaining 80 to 85% of your personal income. Normally, that can be achieved by having a pre-authorized withdrawal from your bank account, and that's the best and a very effective way to save for these goals. As the business grows and you're getting paid more, then you should also be able to adjust the level of savings, so that way you can achieve and stick to that habit and be able to achieve your goals. This is what we mean by pay yourself first. And remember, not to spend more than what you're already making. That's why it's too important to develop a monthly budget for yourself to determine where your money is going at the moment. Find ways to cut costs and set money aside each month. Set up an emergency fund. We advise to recommend to have at least 6 months of monthly spending, in a very liquid, a savings account in case something were to happen either to you, to your business, or even, any personal emergencies. Pay down higher interest debt or revolving debt. If possible, consider increasing your monthly debt payments, and make sure to use credit cards with cautious. 75% of Canadian business owners, and this is a stat, from Stats Canada, 75% of Canadians carry a balance on their credit card each month. In fact, it's quite common for business owners to carry outstanding balances each month on several credit cards, which can result in paying several thousands of dollars each year in interest. So it is advised to pay down more than the monthly minimums on debts and be able to consolidate these accounts for lower interest rates. So make sure not to carry, very high interest credit cards balances. Okay. So I think, Diana, this is a good time for us to launch our first poll. So Diana, you can go ahead and launch the first poll. I'll have a sip of water in the meantime.
Okay. Ivan, can you please make me a host, or can?
Oh, okay. Let me launch it then. That's fine. Thank you.
Thank you.
So please just take a minute just to answer this. Only 2 questions. Okay, so we're going to give it maybe 10 more seconds before I close the poll.
Fantastic. Yes. Thank you.
Okay, so I'm going to be ending this very soon. That's it. Perfect. Okay. Okay, so I'm going to show the results. So the first question is, what's the current structure of your business? So we have 3 options. Let me just show the results here. We have sole proprietorship. We have 75% of the attendees are self-employed or sole proprietors. And also we have 25% of the attendees are, a business incorporations. Okay. So we have more people who are not incorporated yet. They are self-employed or sole proprietors. And we're going to talk about, the difference between the 3 business structures. And the question number 2 is, have you completed a comprehensive financial plan that integrates your business with your family finances? Only 25% say yes, 50% say no, and don't know the 25%. Okay. So I guess, there are a lot of, questions about financial planning and how you can integrate your business together with your with your personal finances for you and your family. Okay. Perfect. So I'm going to stop sharing for now. Thank you for that. I guess I'll close this. Okay. Perfect. Okay, so let's go on. So what's the best structure for your business? So we have 3 of them. As you can see, we have sole proprietorship, we have partnerships, and corporation. So where you're already on your business, or maybe you are thinking of starting a business from the scratch or buying an existing business, choosing the right business structure can have a major impact on the future success of your enterprise, as well as your personal tax and estate planning. Your decision should take into account a range of factors, including the nature of your business and where it's located, the number of people you want to involve in the business, taxation considerations, your potential exposure to liability, and the company's financial requirements. So here we have, this chart, has a lot of info, which we're going to dive into it very quickly. So here we have the key points to consider when deciding on the right business structure for you. And especially for many of you who are sole proprietors, why you might be considering the option to be in a partnership, or why you want to go into, to be incorporated in the business. So first, we have, what we call sole proprietorship. Sole proprietorship is the simplest form of business organization and is often the most inexpensive way for you to set it up. This can be a good option for small enterprises because you as the business owner have direct control over the business decisions and receive all the profits. However, with this kind of structure, you are legally responsible for all the debts and the obligations of the business. So this means that both your business and your personal assets may be subject to claims of creditors. So this is what we call unlimited liability. You also must file a personal tax return to report your business income, and you would include income and losses from your business on your personal tax return as part of your overall income for the year. Your net business income is taxed as personal income, so there are limited tax planning opportunities, which is very different from for incorporations. However, with the sole proprietorship, you may be able to deduct your business losses against your other income sources. It is very convenient as it is very easy to set up, but it's very difficult to have a business continuation plan as it depends on a single person. So that's number one. The second one that we have is what we call partnerships. So partnerships can be relatively easy to set up and often have low startup costs. A key advantage of having partners is that they generally bring additional sources of investment capital and provide a broader management base. However, finding suitable partners can be a challenge. We know that. In addition, this kind of business structure can mean a division of authority, so there is a potential conflict between the partners. A written partnership agreement can help minimize potential conflict. In many cases, it sets out the terms of business, protects the interests of individual partners in the event of disagreement or dissolution of the business, and generally defines how the partners will share the business profits. Your personal liability for the business and the actions of your partners can differ depending on the type of partnership that you are in. So be prepared for the possibility your partners, for that your partner's decision will be legally binding on you, and ensure you discuss all these aspects with your legal advisor. Keep in mind that the partnership's income and losses will be also shared between the partners, who then they have to report that income to Revenue Canada as a personal tax. And you're also considering investing in a partnership, you should also review the tax and the legal implications carefully before making any decisions. So that's for the partnership. Now we go into the corporations. So corporations are a very popular business structure. A corporation is a separate legal entity from its shareholders, but has all the legal characteristics of an individual. It can own property, incur legal liabilities, you can lend, borrow, and carry on business. Corporations also file an annual corporate tax return. And if you're thinking of starting or investing in a corporation, there can be a number of advantages. It can provide greater business continuity, as shares can be bought and sold without affecting the company's continued operation. It is also easier to raise investment capital for a corporation, and you may find that the size and resources of an incorporated business make it easier to attract specialized management expertise. In addition, as an owner, manager, and a shareholder, your liability is generally limited to your shareholding, so your personal assets are fully protected from the company's creditors, unless you have provided personal guarantees for loans to the corporation. Corporations are more closely regulated than sole proprietorship or partnerships and may be more costly to set it up. You will be required to hold annual shareholder meetings, meet certain record-keeping obligations, and possibly comply with legislative requirements specific to your industry. This can mean that you have more admin work, legal, and more accounting expenses under the corporation. Okay. So financial planning looks into all the aspects of all your financial situation and is designed to help ensure that you have enough income in retirement to support your desired lifestyle. You're currently maximizing the tax planning opportunities available to you. You have savings in place to anticipate future expenses such as children's education or recreational property purchase. The financial needs for you and your family and your estate are met in the event of disability or premature death. And you have an estate plan in place that helps ensure that your estate assets go to your intended beneficiaries and minimize taxes. As you can see here from the chart, is that your planning focus will shift as your business moves through different stages of the business cycle, such as the survival, where you look at all the risk management, retirement planning, and other savings goals, or during the growth stage, where you have to set up a key person protection for your key people in your business, get by what we call buy-sell agreements for unforeseen circumstances in the business, or business loan protection. Then you have the ownership transition to sell, liquidate, retain business in the family, and management transition. And also during the maturity stage of your business, you need to set up the will planning, for your wills and power of attorneys, for your estate equalization purposes in the family, tax and trust planning, retirement income planning for you, and also for the people who are, involved in the business. As a business owner myself, we have a lot of opportunities to grow financially. But we need to have the proper financial planning in place that covers all the angles, so there are no gaps in your plan that could affect the business in big time. Basically, I think having the right team of professionals around you would help you implement all this, as long as you take action to revisit all these items. As I said before, I am here, because we work with many lawyers, accountants, CPAs who are able to provide this kind of services together with the financial planner. Okay. So this is just a very nice flow chart for you to identify in which part of the business cycle you are and what are the requirements that you need when it comes to the survival stage, the growth stage, and the maturity stage, and how we can help you put all this planning in place. And no matter you are incorporated, you have a partnership, or you are sole proprietor. Okay, so it is difficult enough planning for the foreseeable events in life, but let alone the ones you don't expect. But a proper risk management plan will address all potential risks that could impact you and your business, even the ones that you don't anticipate. So what are some of the factors outside the market that may jeopardize your business? So these include unexpected health events such as disability, key employee incapacities, critical illness, premature death, health and dental expenses, and some other uncontrollable events. So here's a nice way to see that the government, here in Ontario, because we're in Ontario now, government health insurance doesn't cover all the healthcare costs you are likely to run into it, at some point in your life. To protect income and your savings from health costs, there are various types of health insurance options available to any business owner. Each type of health coverage offers different protection at each stage of your life and also at each stage of your business cycle. During your working years, you business owner, it's important to focus on protecting your family income and protecting the income of the key employees of your company, who are the main sources of your revenue generation, which is normally, in the business, is the sales team. As you move towards retirement, it becomes more important and relevant to protect the financial resources that you have worked so hard to build. Personal health insurance covers lifelong needs. It helps you pay for all the medical and dental expenses. And even now, companies or small companies with only 3 employees or more, they're eligible for group benefits, including the owners. So you can offer this important benefit to your employees or key employees in your business to increase retention. Then we have a disability insurance. It's also important during your working years because it replaces a portion of your income that helps you pay for your bills, for the overhead expenses of your business, in the case you become disabled and you're unable to work in your business. We also have critical illness insurance, which helps you protect your finances against the significant financial impact of a serious illness. And as you know, these illnesses may take maybe 1 or 2 years, such as cancer, for example, to recover, and your business need to be bulletproof ready to overcome these kind of situations. So your business and revenue will not be affected. Lastly, we have what we call long-term care insurance, which will help you protect your retirement income by providing the funds that you need for long-term care expenses later in life. As you can see here, insurance is an essential part of any enterprise that helps you minimize the potential risk associated with unforeseen situations that may affect your business financially. For legal documents, other than wills and power of attorneys for you and for your business, it is also extremely important for corporate owners to have, buy-sell agreements in place, properly funded. If you're the co-owner of a business, it is essential that you have what we call a buy-sell agreement, which sets out the conditions under which one owner has the right to buy the ownership share of the other owner. Triggering events will usually include death, disability, retirement, marital breakdown, personal insolvency of an owner, any illegal action by an owner, and non-resolvable disputes between the owners. So a properly funded buy-sell agreement would help ensure the smooth transfer of ownership interest without having any interruption in the business. Your personal will or living will and power of attorney must be very well coordinated with the buy-sell agreements of your business. So the legal planning must be done as a whole for your personal and also for your business affairs. which, at some point that opt-in can have, a lawyer talking about buy-side agreements and also talk about wills and power of attorney, because I think this is an integral part of any business. Okay, so now let's look at the investment options available for individuals and business owners and how to benefit from tax advantage investments. But before we do that, let's launch our second. Let me see if we have. No, we don't have. Okay, perfect. No, that's fine. So I was gonna say, let's launch our second poll, but I remember that we already have we have done the 2 questions. Okay.
That's correct, line. Yeah.
Perfect. Thank you. And please remember, for those who are, listening, if you have any questions, so if there is any information that is, any questions you may have about this presentation, make sure to put any questions in the chat box, and we'll have, maybe 5 or 10 minutes just to take them out. Okay. Perfect. So as many of you should know, there are registered and non-registered investment options available in the marketplace for you to save and also to invest. So we have what we call registered versus non-registered investments. Or in other words, we have, the limits that the CRA has imposed on registered assets, such as RSPs and TFSAs. And also we have what we call, a non-registered, which you don't have any limit for you to invest. So registered accounts offer tax sheltering on your investments, meaning that while your investments remain in the account, they grow tax deferred, such as the RSPs. And you only pay taxes once the money is being withdrawn from the account. Or they're also tax exempt or tax free under the TFSA option. In that case, the money normally grows tax free. An RSP, or Registered Retirement Savings Plan, it is a plan that most Canadians are very familiar with when talking about saving for retirement. Tax deduction is a reduction in your taxable income as a result of any contributions. A tax-free savings account is a great way to save tax efficiently for short and long-term goals. But the difference, and unlike the other registered plans, contributions to the TFSA do not reduce your taxable income. So here we're just comparing, between TFSAs and the RSPs. Okay. So the main purpose for an RSP is just to save for retirement, whereas the TFSA can be used for any type of savings goals. So for the RSPs, age eligibility for the RSP, there is no minimum age in the Income Tax Act for owning an RSP. However, there is a minimum age to enter into a contract here in Ontario, which is the age of 18. TFSAs, yes, there is a minimum age in the Income Tax Act for owning an account, and that, a person must be 18 years of age or older. The annual contributions for the limit, annual contributions limit for the RSPs is 18% of previous year's earned income up to a maximum of $29,210 this year in 2022. Less pension, normally that has to be calculated minus any pension adjustments plus any unused contribution room carried forward from previous years. TFSA limit in Canada around right now here is $6,000 for 2022, plus any unused contribution room carried forward from the previous years, plus also any amounts withdrawn in previous years. So that means that any amount that you have withdrawn funds, it can be added back this year in 2022. Okay. In terms of contributions, so you need earned income for you to contribute to an RSP, but not to a TFSA. RSP contributions are normally tax deductible. TFSA contributions are not. With an RSP, you can deduct your contribution from the income you report on your tax return. With a TFSA, you cannot deduct your contribution on your tax return. In terms of unused contribution room, both of them, you're able to carry forward the room that you haven't used for the TFSAs and also for the RSPs. And in terms of growth in RSP is tax deferred until funds are withdrawn, and the growth in the TFSA is tax-free. When it comes to the withdrawals, you pay tax on your RSP withdrawals because you made the contributions with pre-tax dollars, and withdrawals from RSPs affect federal income-tested government benefits such as the old age security or the GIS, which is the guaranteed income supplement. Whereas TFSA withdrawals are tax-free because you made the contributions with after-tax dollars. And they do not affect federal income-tested government benefits such as the OAS or the GIS. When it comes to the withdrawn amounts, RSP withdrawals do not affect the contribution rule. That only happens with the TFSA. Amounts withdrawn from a TFSA are added to the contribution room in the following year after the withdrawal. And when it comes to the plan maturity, the year that you turn 71 is the last year in which you can make a contribution to your RSPs, whereas for the TFSA, there is no upper age limit on contributions. So you can contribute lifetime if you want to, as long as you're not going beyond the 81,500 that we have right now in Canada. Okay. So for those who are incorporated, so here's a chart that shows the business income tax payable for corporation here in Ontario. As you can see, the combined tax rate for CCPCs, which is corporations, so Canada-controlled private corporation, it is around 12.2% for the first $500,000 of active business income, and you're eligible to qualify for the small business deduction. And anything beyond that would be taxed at 26.5%, but still, it is very low compared to personal tax. And that's the reason why many business owners want to incorporate their businesses, as tax implications in active business income is much less compared if they were to receive it themselves and be taxed at a higher tax bracket. And when it comes to savings and investing inside the corporation, you could invest in any type of instruments such as stocks, bonds, mutual funds, cash value life insurance policies. But you need to understand that some of the rules involving taxation on passive investment income is that the government has certain level of taxes when you have more than 50,000 of a passive investment income. So that's why you have to be very careful, with that rules. That has changed, the last few years. But this comparison here shows the advantage of investing inside a corporation due to the lower tax implications and the growth deferral for non-registered assets. The difference between your higher personal tax bracket and the lower corporate tax rate may result in the tax deferral for your investments. That would be the amount of tax savings generated compared to if you were to invest the funds yourself in a non-registered investment account. It is also important to identify what would be your personal tax bracket when you're planning to withdraw your assets or your investments from the corporation, and when you are able to liquidate those investments and the kind of investment you have at that moment. So let me just illustrate this, with a quick example here, just to make things a little bit clearer. See, so we have Andre. Andre lives in Ontario, and he is in the highest tax bracket. His corporation has, let's say, $10,000 before tax surplus, and he doesn't have any need of the funds for the business or personally. So he decides to invest the funds for the future, let's say. So if he's getting paid as a salary from the corporation, well, number one, he would be a deduction from the business. But after paying taxes, this $10,000, it would translate to $4,647. So that means that he's going to be able to, to invest only this amount of money in let's say in a mutual fund. If Andre's corporation retains the surplus, the after-tax amount available is subject to only the 2%, which is the corporate tax, using the small business deduction, and that would leave Andre with $8,780 available to invest. You see, there is a big difference of amount of non-registered savings that you can invest if you were to do it inside the corporation or you were to do it, yourself. And also a key factor as well is Andre has the option to withdraw the funds from the corporation to him whenever he feels is the right time to do it. Normally, let's say Andre stops working or he's retired, then his income is zero. Maybe at that point, he will decide to cash out and start taking that money out of the corporation. And the years that he had this money invested, look at this, there is a $4,000 difference, and that investment has grown compoundly. And that's the reason why many corporate owners decide to invest, their assets inside the corporation, just for tax planning purposes. Okay. So any registered and non-registered investments can invest in any of the investment options, such as stocks, bonds, mutual funds, GICs. But it's important to consider the tax implications and the investment solutions that provide the most tax-efficient way to save, especially if you are investing in the non-registered account or inside the corporation. That's why we highly recommend to explore your options with a qualified financial planner that not only would be able to recommend a portfolio that would help you grow your investments, but we would also look at all the tax implications and how you can minimize taxes for different investment options, especially if you're investing inside a corporation or in a non-registered asset. Something to note here is if you have a corporation and you're paying yourself a salary or dividends, I would all recommend to use what we have available, the RSPs and the TFSAs, because there are studies found that people who are getting paid salaries, obviously that's a business deduction from your corporation, and then you can offset that income using RSPs, or you will be able also to invest in TFSAs. But many business owners, they have very low RSP room, so that you would be able to have extra cash invest in the corporation, so you can take advantage of the tax deferral by using investment options and solutions that we have available to our clients. Okay, I think. So what are the key takeaways for today's presentation? Now we're coming to an end. So business financial planning is the single most effective way to make the most of your income for your business and for your family while minimizing tax implications. What works for some people doesn't work for all. The makings of a good business planning is the one that protects the business from any unpredicted events and have strategies in place to offset any financial risks. Making good use of the registered and non-registered investment solutions to grow wealth is key, as long as you have a financial plan that supports it. And keep in mind what I mentioned before. Pay yourself first and have a written financial plan would provide you with a peace of mind so you can focus on growing your business, growing your assets, and that you will be, less worried about what if something were to go wrong. Okay, so those are the main key takeaways. So now I'm ready for a few questions. Diana, I guess we have a few questions. Maybe this is the time now that we can take, and then I'm gonna pause for 1 second so I can have a sip of water. Go ahead, Diana. You have any questions?
Yes, Ivan. So we do have a couple of questions from two of our attendees. One of them is, well, actually, both of them are from Camila Ospina. One of them, I'm going to bring it up live. Let's see if we can see can you see the question there?
Okay.
It says, if you have a family small business with only 4 members working in the business, but we are not incorporated yet, can we have group health benefits for the company?
Yes. So as I mentioned before, now small business owners with maybe 3 or more employees, you have the option to have a what we call a group benefit package for you and for the business. And it's normally it does a business deduction for the business. You will be able to have health and dental benefits for you, for your family, and the employees. And the good thing about these plans, Diana, is that there is no medical underwriting. So that means that we don't really care, if the employees have any medical conditions. We will be able to offer health and dental benefits without asking any questions. So in case, they have, let's say, pre-existing conditions, or they have any medications that they have to take for some reason or any treatment, insurance companies nowadays, they're able to offer group benefit package without asking any any questions, and that you will be able to make claims, in terms of that. So that's a good question. And yes, it is available as long as you have 3 employees or more in your business.
All right.
Oh, by the way, and it doesn't matter if you are incorporated or you are self-employed. So it can be self-employed, or it can be incorporated, or you have a partnership. It doesn't matter.
All right. Well, thank you so much for answering that question. Now I have another question from Camila again. What kind of investment options are available to invest inside a corporation? Which ones will you recommend to be more tax efficient?
Yeah, so corporations, as mentioned before during the presentation, they have, tax advantages, as I said before, because you have money invested in the corporation, which it can grow tax deferral. But you have to be very careful, because there are new rules coming. Actually came, a few years ago, that it will be, something called passive income, which is basically the return that you get from any investments. You're going to be taxed at a 50% beyond $50,000. However, there is an account, or there is an investment vehicle called corporate class funds. And corporate class funds is an investment account that works very similar, to a mutual fund, but you will be able, to minimize interest taxes, dividend taxes, capital gain tax, so that way the business owner is going to have, a minimized tax when it comes to investing. So it is available, but you have to be very careful which kind of investment you choose, because the only investment account that you can invest inside corporations is what we call corporate class funds. And that's as a portfolio where you have, bonds and stocks, but it has the benefits of a corporation as well. So your taxes would be totally minimized. So you don't go beyond the 50,000 threshold. So that way you will be able to, not to pay taxes and be able to grow your assets inside the corporation.
Oh, okay, perfect. That's fantastic. I also have one last question from Johan Flores. He says, what are the benefits of a savings bond?
Savings bonds?
Savings bonds, yeah, because I believe you mentioned in one of your slides.
Johan says savings NODI. What's NODI?
Savings
bonds. Yeah. Okay, yeah, got it. Yeah. Thank you, Johan. Yeah, so saving bonds, I guess you mean maybe Canadian bonds or corporate bonds. So basically, corporate bonds and Canadian bonds, those are what we call fixed income assets. Fixed income assets, basically, they give you an interest upon maturity once you buy the bond certificate. So when you buy, let's say, a bond, let's say a corporate bond or a Canadian bond, let's call it that way, then you will be able, to invest in a bond security with the promise that after 2, 3, 5 years, you will receive the principal back plus maybe, a 2% or 3% interest on top. So that's what we call, bond. Is in that example, it's much safer to invest in bonds than in stocks. In stocks, obviously, you're taking much more risk when you invest in the stock market, buying shares or stocks. But when you buy bonds, then you're taking, much less risk. But normally, when you have a balanced portfolio, you will need to have the combination of the two. Having a good diversified stock portfolio, a very good diversified bond portfolio, and that's how we can measure, what we call the asset allocation. So between bonds and stocks, and that's how we can determine how risky the portfolio is or how safer the portfolio is. So what is the advantage? Is basically it's a safer security that you have for you to invest, that the principal is not guaranteed, but they have the promise to give you the money back, and also to give you the interest on top upon maturity. So that would be maybe my short answer.
Oh, okay. And yeah, that's just one of many investment vehicles, right? Like you mentioned, there was segregated funds, mutual funds, stocks, etc. And if anyone has any further questions, they can always reach you directly. I'm gonna just
let me just show here. That's my contact info.
Oh, okay. You have it over there. Perfect. Thank you. Yes, let's share your email address, website, all the places where people can reach you directly.
Exactly, yes. And something just to mention, like I've been helping, business owners for the last, going now 14 years. And I'm, really willing to work with any of you in case you have any questions about financial planning, how you can surround yourself with the right professionals so you can actually make good use of your money. You can minimize taxation. If you are in the process of becoming incorporated, how you can do that and why you should do it. Maybe your business is not ready yet, or maybe it is already ready a long time ago and you haven't even seen. And as I explained before, you have options and you have many solutions. And especially you have tax planning opportunities, in the business. So me as well, I'm a business owner, we have a lot of options to grow our business and also to grow financially, but we have to be very careful because as the business grows, there are much more complex things that you have to consider. The risk side, and also you have to consider the investment side, tax implication, and also you want to make sure that if God forbid something were to happen to you, what's your plan? Your plan is to keep the business in the family, to wind down the business, to sell it, but you need to make sure that your business is sellable, like somebody would be able to take it over. So yeah, so we can have that discussion. That's my contact information. And by the way, I don't charge for consultation. That's something, that we always say, we don't charge for any questions that you may have. And I invite everybody, to reach out to us for a private consultation. If this is something that's important for you, for your business and for your family, we're here to help.
Well, thank you so much, Ivan, for all your information, valuable information that you share with us tonight. I'm going to quickly just let the guests know about Data Opting. Data Opting is a digital marketing and web design company specialized in small, medium-sized business. And we're happy to help anyone as well with any questions that you may have. Thank you for attending this evening, and have a great evening, everyone.
Thank you, Diana. Thank you, Data Optin. Have yourself and everyone a good night.
Bye-bye.